We are live. Good morning, all of you in YouTube land and the rest of you that are listening. This is the beginner's class. Listen, if you're listening to us the first time, don't panic. You might be wondering, hey, where do I listen to these guys? Well, you can catch the back episodes right here on YouTube. But if you want to get into the meat and potatoes, you want to get into the nitty gritty, you want to know how to start building algorithms that can trade on your behalf, that can execute these trades, that shows you how to properly get in and get out. Like your name is Chuck Norris, and it's a Delta Force movie. In and out. Fast as what is it? Fast as smooth and smooth as fast.
I
Well,
think
you
something like
need to
that.
something like that. You need to join AlgoFactory.tech. AlgoFactory.tech is a place where you learn to trade your job and upgrade your life. Cowboy's here every day. He is the professor extraordinaire, teaching you the technicals. Then, of course, you got me, the monetary monkey of mayhem, working in the background. And there's a 1-2 combo that is unbeatable. So, without further ado, folks, AlgoFactory.tech. Sign up and make a positive impact on your bottom line. Cowboy, let's get into it.
All right, sounds good. So, yeah, like V said, there's going to be, especially for this is a beginner class, right? Starting at about 6:30 Mountain, so that would be 8:30 EST. We go through the beginner concepts, right?
Yep.
And basically, we like people to come in who are either brand new traders or not even traders yet, who are interested, and they can ask all kinds of questions. Although I don't see any questions having been asked yet. So, we do have a few people who are listening now, I can see. So ask some questions, everybody. That's what we're here for. You know what I mean? This is the beginner class. Of course, I have plenty I can talk about from a beginner standpoint. Certainly, that's I can bring some stuff up, but I'm going to open it up to questions first because that's what this is all about. Let me look back. Let's see here. I'm looking for some questions. Somebody asked about Kingfisher. So we'll go ahead and cover that for a few minutes. This is for your crypto traders, okay? And this is by the time you need Kingfisher, it's going to be a little advanced. But even if you're just kind of basic, looking at Bitcoin or really any crypto, whether that be spot or derivatives or whatever, there's a really great service out there, and it's essentially free. You basically can spin a wheel to get credits, right? And you spin a wheel every hour, or if you want to tweet, you can do every half hour. And essentially what it does is it tells you where the liquidity is. So what this is going to kind of, this conversation is going to push towards market maker theory, right? And so I guess we should talk a little bit about what a market maker is and how markets work. And then the Kingfisher program is going to be a great way to illustrate that. Okay, so let me go ahead and open up a chart. It's probably the best way to do this. Give me 1 second. And for those of you who are paid members in the Telegram, the Gorilla just put a link to the Kingfisher.io in there to check out. So let me go ahead and share the screen. And here we are. And I think a 3-day chart will do. All right, so we're looking at Bitcoin. And the way that things work in markets is that liquidity is important, right? So you have players that are retail, and then you have players that are more, we'll use the term institutional, right? So people who have, they just have a lot more money. They might be working for, say, like a family office or even a large company. Institutional traders were secretly buying and trading Bitcoin way back, as far back as 2016, 17, maybe before that in dark pools. So they were telling us not to buy Bitcoin. They were saying,
fire anybody who trades Bitcoin.
Yeah, that's our buddy Jamie Dimon, who actually is not necessarily a bad guy, but Jamie Dimon said that. He says that he'll fire any of his employees who are buying or trading Bitcoin, right? But then that turned out to be not true. However, those big money players, in order to enter and exit a position, what they need is liquidity, right? So let's just say Bitcoin's market cap at that time, I'm going to guess was, I don't know, 100 billion.
Something like
It
that.
wasn't a trillion, certainly. And so if you have 100 billion, that's a small market for these guys. Like, these guys are used to trading like just billions upon billions in the bond market and, equities and stuff like that. So basically what they'll do is to have a sizable position, especially if they're going to play like in the derivatives and things like that, they need people like retail, to be involved in the trade. By the way, let me blow this screen up because it's going to be hard for people to see unless I expand it. So they need people to basically give them support for their orders. So if you have somebody who wants to go short, say right here, we'll save that. Let's just say I'm going to do a real scenario here. I'm going to go back in time using the replay function on TradingView. And the paid members, actually, I show them how to do this inside our website as far as how to use this function on TradingView and things like that. But essentially now I've gone back in time, okay? And this is on a 3-day chart. So each one of these candlesticks that you see up here on the chart, that's 3 days worth of price action. Okay, so at this time, this is going back to February, halfway through February, just a couple months ago. And price was on its way up. And I had algorithmic indication the price wanted to continue up at that time. But, until it happens, you don't know if it's going to happen. But it was certainly on an uptrend. And so basically, we learned that price wanted to go up a little bit farther, perhaps to say, 28,000, 30,000 level, right? And I told people, like, a lot of people, like, hey, Bitcoin's probably going to go to 30,000 in the next like few weeks, next several weeks. I said that to a lot of people that are, I have a few trading groups, right? And a few normies that I, throw bones to here and there. And so
what's the price of BTC right now?
Right now, price of Bitcoin right now, I'd have to go to another chart here. Oh, it's 27,000 right now.
Damn it, man. I should have bought more. I spent all my money on Pepe.
Pepe coin. Okay. So basically, this is what it was. Now, in order to get there, so you have to have buying pressure, right? You have the big boys, sure, they want to take price all the way up there. Then what they want to do is they want to take profit. They want to go long here, whether it's on the derivative market. And sorry, give me 1 second. So whether it's on the derivative market or spot, they want to go long. And what they're going to need to do, though, is they need people to fill their orders. If they're going to buy and they have a lot of money, if you have so you have 100 billion market cap, right? I'm going to put this here. And that means that 100 billion, TradingView, $100 billion. So 100 like this. Okay, that's the size of this. That's how much dollars is in Bitcoin at this time. I'm just making that number up. Right now, it's actually closer to probably $500 billion. It's like 500 million. But we'll just keep the number simple, right? In order for that to work, right, if you want to make a trade that's, say, $10 billion, and this is your market cap, maybe let's just use the term circulating supply. Let's just say the tradable supply, the amount of money going in and out at that given time is not going to be that, right? It's going to be something like 5 billion. Like that. So it's going to be a much smaller number. And let's just say these guys want to do a trade that's $5 billion, right? They'll hear that, and these numbers are not real. Like I said, I'm just making them up. They're much larger than this. But if the money going in and out of the market is $5 million at a time, right? The rest of it's just sitting there, people hodling it. The other 95, billion is just sitting in their wallets, not being traded. If somebody takes a $5 billion trade and there's only about $5 million going in and out over like a 24-hour period, they're going to severely manipulate the price, right? So if some big player wants to do that, what they're going to do is the price is just going to shoot up really hard all of a sudden, right? and it's going to be out of whack, and it's going to come back down, and they're going to buy, and they're going to push the price up to 27,000, and they're going to buy more, and it's going to push it up to 28, because there's going to be no sellers at that time, right? And they're going to get what's called slippage. So whenever there's a buyer, there's got to be a seller. And if let's just say the $5 billion, like I said, is going in and out of the market at all times, well, you're going to have this. You're going to have, and roughly, right? Let's just say 2.5, 2,500,000,500,000 sellers, right? You're going to have, let me make this a little more reasonable. And then you're going to have just as many buyers, right? So that's more or less going to be the case. You're going to have maybe a little more sellers, a little more buyers. If the price is pretty stable, though, it's going to be relatively even. Oh, okay, so you want to make this big trade of $5 billion. Well, there's only $500,000 dollars worth of sales. So once you break that, you're going to manipulate the price and push it up really high. And then the market's going to catch up. So because you push the price past that threshold, and now you're buying at 27, 28, 29, 30, because you pushed it there by buying it, and then the rest of the market's going to come back later, and it's going to come back down. All that money you bought at 28 and 29, that's now going to be worth 26. And you're going to have to wait for it to come back to your value, right? So the market makers understand this. So they're not going to do that to the market, but they want to make these big trades. So what they need is they need liquidity. They need to find a place where there are more than 2,000, than 2.5 billion, buyers and sellers. Okay, so how do they do that? Well, there's ways to estimate that, and then there's ways to know, right? So the way to estimate that is by using some techniques that we use over at the algofactory.tech, okay? And there's a lot of markets, like I'd say the vast majority of markets outside of crypto, you don't have that information unless you have $20,000 to pay for a Stuart, we'll talk about leverage. Unless you have $20,000 a month to pay for a Bloomberg terminal, you're not going to know where that liquidity is. Okay, and liquidity you're going to find in certain areas on the chart. So we do have methods over at the algofactory.tech to do that, and you want to do that because price always goes towards that liquidity. Okay, but the unique thing about cryptocurrency is that we have something called the kingfisher.io. And again, the Gorilla put that link in our Telegram chat, and I'm going to show you guys what the kingfisher.io is. Okay, so, but I'm going to illustrate this before we even go there. So the price itself needed liquidity, and there's pretty good chance that there's going to be some liquidity, let's just say right about here. And before it can go up, it's going to need to dive down and catch that liquidity, because those large players, they don't want to crush price up. They're going to let price kind of fall, and they know where the liquidity is because they have visibility, which is unique to cryptocurrency for us to have visibility, because normally it costs a lot of money to pay for that data, but we have that in crypto. And they found that liquidity where there was a lot of buy orders and sell orders and people in the market where they had that volume to fill their order and take price up without ruining the market, without getting that slippage and losing all that money. So it's essentially what happens here. I don't know if I drew the exact perfect data there, but you'll see the action happen anyway. Price goes up, and then it dives down, and then right there. So they knew the liquidity was here, and they either pushed price down, which is at least part of the truth, and or price naturally made its way down there, and they had their orders ready. They knew that if price got to this area, a lot of sell orders would hit. They knew there was a lot of liquidations in this area. They knew that people went long right here, right? And so people go ahead, they bought their Bitcoin, and they have a stop loss right below that, like right here. So let me demonstrate that a little more clearly to the new people, okay? So when you are trading cryptocurrency, whether it's spot, whether it's derivatives, you are going to have, if you're smart, what's called a stop loss. So people who bought right here, or maybe like right here, right in the middle of this box, that's a short box. People who say entered a trade right there. Let me make this a little more clear. I'm going to draw a line right where they bought their Bitcoin, right here, right? And then what they're doing is if the market goes down, you want to get out before it goes too far, right? If you're going to do measured trades, if you're going to be a trader, you're not going to stay in a bad trade. You're not going to stay in a trade that's a losing trade. So people use, at least smart ones, use what's called a stop loss. Or if you're in the derivative market, yes, I always use a stop loss. I never not use a stop loss, except for my investments. That's another story. We're going to talk about that. But there's also an area where the trades will liquidate because derivatives are a different story. And we're going to explain that. We have one of our clients here, Stuart, that's asking us to explain leverage. If there's time today, we'll get into it. If not, Stuart will discuss it maybe tomorrow or during your other class. But either way, you're going to have a lot of people exiting the trade right there. And when people exit a trade with a stop loss, all a stop loss is you're telling the computer to sell right here. If you're going long, if you want the price to go up, if your trade is based on the price going up, if the price hits that area where you want to get out of the trade, it's going to automatically sell for you. And there's a decent chance that because price kept going up, a lot of people went long right there. A lot of people bought right here. And a lot of people have liquidations here because they were playing the derivative game. And that's where a lot of things happen in crypto and most markets. So the derivatives are another story. You don't hold the asset itself. What you're doing is you're buying contracts for the asset, and you're making basically a bet against somebody else that the price is going to go in a direction. Okay, so and when you do that, when you borrow money, you have to have a certain amount of money on the trade to keep that trade going because it's not all your money. And when that money runs out, your trade liquidates. That means the trade is basically sold for you. So whether you set a stop loss here or whether the computer sells it for you because you ran out of money to keep that trade alive, that's going to cause downward pressure on price. It's going to cause a panic. And then that panic is going to engender more panic, and price got forced down into this area. And the market makers knew that would happen. And so they set all their buy orders right in this area. And then after that happened, they were able to fill their orders without messing the market up. And then they were able to have the price continue upwards. Where's my button here? And there it goes. See? So they were able to do that. And then what they need to do is they need to also sell where there's a lot of that liquidity. So they probably have on their maps that there's a lot of liquidity around 30,000, and they just let all the excited moon boys, the people who are just so like, oh, this is going to go up forever. Well, what they did was they set sell orders up here. And during this period and this period, those sell orders all got hit. All that sell pressure that they needed to get out, right? If they just started selling on their own, price would have gone down and they would not have been able to collect as much money. If they hit the sell button and they sold all that 5 billion fake number, that I made up, it would have gone down from here, right? But they didn't do that. They let the market sell for them, right? Let me rephrase that. They let the market provide that exit liquidity, meaning that they let the regular Joe keep buying right here while they were slowly exiting, right? So they could slowly exit that 5 billion instead of all at once to push the market down. They slowly sell it bit by bit by bit, all in this area. That's called a distribution, right? So that's another term, but we won't go there. So they had all that sell happen, and slowly they sold it, and then price kind of came back down to earth, which is basically where it is right now. So that's how market maker theory works. And I know that was kind of a crash course. We can do that again. Again, I didn't have any questions from anybody in our group as to what to do on the beginner show today, so I'm kind of winging it. But we do have a question from Stuart Holden. So what is leverage? Okay, so leverage is contracts. It's like when you buy Bitcoin, it's called spot, right? And a good example of this is in the precious metals market. So when you're trading on like an ETF, like GLD or something like that, supposedly it's, some of these are, if it's a spot ETF, it's supposedly backed by spot gold. I doubt that all of them are. I doubt that any of them are really, but supposedly you can back them. But you have like the COMEX, for example, right? Well, what they did after not too long ago was, okay, so you're not trading gold itself, but you can settle in gold or silver or whatever your commodity is, right? So if you settle, like if you make a trade and you get some profit, you're supposed to be able to get back whatever you're trading, whether it's gold or whether it's silver, even though you put dollars in. Well, here's the thing. They changed the rules, I think, a couple of years ago, and this is more V's territory than mine, but they made it so that they could settle in cash. And the hidden question behind that is, what, do they not have the metals to back it up? If they have the option to settle in cash, if there's a force majeure event, if the most important people need to get their metals first, which is kind of a force majeure definition, does that mean that there's not enough metals to go around to cover the trades? That's the supposition. That's what everybody thinks is going on, is that there's not enough metal to cover it. So with leverage, what it is, right? Let's just say you go to the COMEX, you got $10,000, but you want to make a $100,000 size trade. Well, what you're doing is you're borrowing $90,000, right? So you're putting in, let's just say you want to do a times 10 trade, and you have $10,000, and you want to take a $100,000 position, right? So what you're going to do is you're going to borrow basically 10 times your money. And when you do that, you end up, what you can do there is, like, you can take a smaller amount of money and turn it into a larger amount of money, right? But here's the problem. Your money is going to go up 10 times as quickly, your profits, and your loss is going to happen 10 times as quickly. So this is why people get liquidated, because if you don't have enough money to cover that trade, if you don't have enough money to keep your margin alive, so this is the way it works. There's margin, and then there's your the money you've borrowed, right? The leverage. So your margin, let's just say, is this 10%, and the leveraged amount, the borrowed amount, is going to be this other 90%. So as price, let's just say this is a normal trade right here. This one here is the same size trade, but it's all your money, right? Well, in this case, if price goes up 5%, then to you, it's going to feel like it went up 50%, right? But here, if price goes up 5%, where it's all your money, it's just going to feel like 5%, right? Okay, here's the problem. If price goes down 5%, right here, this same exact amount, over here, it will have gone down 50%. And that's literally the size of this entire trade, right? So even though it only went down 5%, it went down just as big as this entire trade, which is the entire amount of money that you risked. And if it goes any further, now you're not just losing your money, you're losing the money that you borrowed. And they're not going to allow that, right? So even though it only went down this 5%, the actual money in the trade went down 50%, and the amount that you borrowed is now dried up because you're not able to support it, and you get liquidated. That's the way leverage works. On your spot trade, if it went up 5%, that's all your money. That's just your money, and it's going to feel like 5%. And if it goes down 5%, you didn't borrow any money. It just went down 5% and you lost 5%. So that's it. And so with spot, you never really lose whatever you put in. I mean, outside of some weird, Bitcoin gets outlawed or disappears. But aside from that kind of stuff, you're always going to have that same amount of Bitcoin, right? You put in $100 in Bitcoin, it goes down 5%, you got $95. But if you're at a times 10 trade, right, and you buy $100 in Bitcoin and it goes down 5%, but you're at a times 10 leverage, now you're left with $50 instead of 100, because you lose your money 10 times as quickly. So leveraged trades is something only to be done if you understand how to do it. You can't trade Forex really without being leveraged. In the US, it used to be like, I think 200 to 1, where, because you're trading fractions of a penny. All right. So, in Forex, you pretty much are going to be using leverage. So that's why, Forex trading requires a certain amount of education. We do provide education for that inside algofactory.tech. Forex, cryptocurrency, derivatives, you have to check with your jurisdiction to make sure you even are eligible to trade leverage. And that's available for, I trade on KuCoin futures. I have a setup that allows me to do that legally. I think New York might be trying to keep that from happening. I think New York might be not allowing you to use leverage, but you got to consult, your own advisor for that kind of stuff. And in general, anything we say on these shows is all entertainment and education purposes only. So, make sure you consult a licensed professional before risking your money on markets, because that is risky. Nothing we say is intended as investment advice. Before we go ahead and get off YouTube here, go into our main live lab for our paid members. Be Good is asking, we're going to talk.
Yeah, we'll get into that.
This might be, I think that's more
the live lab.
That's a live lab. Yeah, we'll get into that later.
So we'll get into
we're
that
going
in
to talk
about
about altcoins just for those in YouTube Lab. In the live lab, we're going to talk about altcoins today. Apparently, that's what B Good's assuming we're going to talk about. So, you know, I don't know. I guess B Good's like, I know you're going to talk about altcoins. I'm like, I didn't know I was going to talk about altcoins, but if that's what you want to talk about, we can talk about it.
No, it was what I was going to talk about. Remember?
Okay. Oh yeah, that's right. You had oh, dude, you got the secret sauce today, don't you?
Got a little bit of a drip, just a little bit.
Yeah, you got like something to do with like and I'm not going to release too much here, but something to do with like
institutional side. And,
the institutional side.
Yeah, and their views on altcoins and meme coins. So it'll be a little fascinating for some of y'all and give you guys some a more pragmatic institutional perspective on how they view it. Because look, none of these institutions that I deal with, that I'm connected with, none of these people, they have no, what's the word I'm looking for? They're not married to any one of these things, right? They're extremely pragmatic, and that's a viewpoint that Cowboy and I always stress in Algo Factory, is to be pragmatic and to look at things from a profit standpoint. So we're going to get into that later in the lab today. So Cowboy, let's switch over.
Sure,
Sayonara, YouTube.
Hey, hold on, we got just one last bit on that. What's going on is that people are interested in like Pepe coin right now, stuff like that.
Yeah.
And my assumption is that those are trash. But the gorilla, with his connections that are so, you know, high up in the financial world, says that the institutional money does have a view on that. And so we're going to talk a little bit about that, whatever the gorilla is allowed to talk about, but that's in the paid group, which is over at algofactory.tech. So we do hold on to those videos for a few weeks for people to review. So if you're interested in what the big money does with meme coins, how they make money on those, if they make money on those, what their view is on those, go over to algofactory.tech and sign up, and we will have that video available to watch for 2 weeks.
Yep.
So that's that. $50 a month for what we're doing. Yeah, come check it out. It's amazing.
And with that being said, Cowboy, let's switch